Okay, hi. Welcome everybody. My name's Steve McGregor. I am Business Development Director for Tavistock Wealth, and I'm delighted to be joined today by Alex Livingstone, who heads up our FX, our currency hedging, but also the trading within Tavistock Wealth. So I've got a really interesting session today, which I'm really looking forward to, because we can lift the lid a little bit on how we trade the portfolios, the Acumen portfolios. Alex is your man for that. So Alex, welcome. Very nice to see you. How are you?
Good morning, Steve. I'm good, thank you. Yourself?
Yeah, I'm all right. Okay, thank you. Had a haircut. The kids are back at school. I'm back on the golf course. It feels like we're opening up, and I've had my jab. I had my jab on Monday, which is good. So yeah, I'm all okay. What about yourself?
Life is returning back to normality. It's great.
It
Yeah.
is, and
Alex.
helps with the weather as well. The sun's come out, which is always a good thing. Alex, we've got about 15 minutes to talk about what you do, which I know doesn't do it justice. It's far more complicated than that. But I think the first and foremost thing that we should focus on is the trading side of your job. I know that a couple of years ago we brought the trading of the Acumen portfolios in-house, and we might just glibly say that every now and again to advisors, but it doesn't really mean much to them. So I wonder if you can explain how it works, what you do, and what benefits it's brought to the running of the management of the Acumen portfolios, please.
Yeah, for sure. So I'll kind of go back to the start. As you say, we brought the trading in-house in 2019. What that meant was clearly we used to basically send our trades that we wanted to execute over to another party who would then execute them on behalf of ourselves. But we're taking full responsibility of that, and we're actually executing the trades in-house. How do we do it? We do it via a software called TradeWeb, which is excellent, and it basically allows us to put some of the biggest market participants and sort of biggest names out there into direct competition. So what we'll do is we'll send a trade out. Say if we want to trade in the S&P 500 ETF, we'll put a trade out to some of these biggest names, and then we'll trade on a best execution basis. So the best quote will then basically take them up on that, and that will be our price that we'll trade at. This year has been an extremely volatile year, as we all know. And over that year, we've traded around 1.65, just over 1.65 billion sterling in ETFs over this year. So, I mean, we've been busy. We've had to do a lot of changes in the portfolios, but these are the kind of times when actually having the trading in-house kind of comes into its own.
Sure.
Because we can actually have direct oversight of where we're executing at. We can turn things around very quickly, and we've now got the authority to decide when markets are very choppy, actually, you know what, it might be best to hold back on that execution and sort of maybe look to work trades a different way, or go about it, or look at it a different way, you know, maybe not trade at risk, but look at trade at NAV, or wait for this to, or split trades up, you know. So that's kind of a little bit of the high level overview.
Can I just ask you a question there? You talk about volatility. I mean, we speak about volatility a little bit. We know that last year, with the onset of the pandemic, the massive sell-off in February, March, the big bounce back that we saw from the March 23rd, we talk that 2020 was a volatile year. 2021 started as a volatile. Just out of context, or put it into context historically, how volatile have the last 12, 18 months actually been?
Well, I mean, it depends where you're trading in terms of how liquid your portfolios were, and clearly some of the more liquid assets felt that illiquidity to a superior sort of extent. So you had sort of, as I'll go through later on, actually, we had some of the even more liquid assets, something as basic as a MSCI World, which would usually trade with a spread of around 5 basis points. That in peak times in March, that blew out to 50, 60 basis points.
So the difference between what you can buy it at and what you can sell it at has expanded from 5 to 50 basis points.
Exactly. So you've kind of had a tenfold increase there in terms of, basically, as we know, I mean, the COVID pandemic kind of hit us, and it kind of took the world by storm. It was that intense couple of days where actually market makers were kind of saying, God, do we want to be taking on these trades? And actually, if we want to be taking on trades, we're going to charge clients more, because
Sure.
we don't know if we can settle these things. We don't know what's going on. So, and that obviously hits the, as I say, the more illiquid assets to a greater extent. so that's basically what we kind of felt, and these kind of shockwaves that rippled through the markets.
And so I mean, that's really hit a nail on the head from my perspective. So that really brings the benefit of bringing the trading in-house to the forefront, because going from a position back in the day when I was kind of in a similar position of running money for a company looking to execute trades through ETFs, we're doing it through a platform. We don't really know what we're going to execute at. And during these periods, with spreads widening as much as they have been, you could really be on the wrong side of that trade. And through no fault of your own, trying to put the portfolio and put the client into a position that you think they should be in, you could be losing out significantly just by the sheer trading of that ETF. So that's from a risk perspective, to ensure that we've got the portfolios in exactly the same right situation that we need to be in without costing the client a significant amount of money on the trade itself is huge from my perspective.
Exactly, and it's an area that actually I don't think has been quite opaque in the past, and we're trying to be very transparent in terms of how we trade, and trying to get across where how much these actual trading costs are, I think it would maybe help if I kind of come back to the basics, if that's all right, Steve.
Yeah, absolutely. So, I think you've got a few pictures that we can look at, a few slides, which would be good.
Exactly, and kind of just bringing it back to, I mean, this whole trading. Why, when, and why do we do it? I mean, clearly, we're either trading, firstly, when there's a subscription or redemption within the funds, so i.e., a client's deciding to buy or sell out of or into the funds. So therefore, we need to basically buy or sell securities, and also when we're deciding to make changes in the portfolios, i.e., there's a tactical opportunity and we want to buy a certain security or sell a certain security. So that will be then my job to try and decide how to basically get the best execution for the client. And how does that actual trading work in the markets? Well, to coin a phrase, there's no free lunch in finance, unfortunately, and as we say, it always costs money to do things. So, and that's the case in finance. So unfortunately, you would love to be able to buy low and sell high, right? That's how we'd like to make money. But unfortunately, there's a market maker, and they're basically going to charge you to basically be buying a security. So what they're going to do is they're going to force you to buy at a slightly higher price, which is the ask, and they're going to offer you to sell at the bid. And that's the lower price. And if you take those two prices and divide them by 2, you get to the mid price. And that's just simply, that's the mid price between that bid and the ask. Unfortunately, we would love to be trading at the mid, but as I explained, the market makers, to get to access that liquidity, you've got to pay. So you've got to basically be paying the spread. And so when we're doing our trading, this is sort of something that we're looking at pretty closely, and we're looking at how much the spread of an ETF is at the current time versus its historical averages. There'll be lots of factors that will be impacting that sort of spread in terms of how liquid it is or how illiquid the underlying securities are. And all those different factors will basically play into how the spread is trading at the current time. And also it's a number of other factors, looking at the volume that's going through a certain ETF and sort of impacting on the secondary demand in the market, and that will impact on where the spread is currently that you're sort of being offered.
Sure.
But coming through into the actual sort of market dynamics and how that spread sort of evolves with different sizes and how it evolves sort of through the course of natural trading. Effectively, what we do is, as sort of going back to the beginning, is when we've got a trade. So I think on the slides we've got that we're trying to buy an ETF. And so what we're doing is we want to be buying near as close to the mid as possible, but unfortunately we've got to pay. So we've got to pay the ask. Now that is the screen ask. The screen ask is the top of the order book. So what that is basically that's the order book is giving the smallest number of shares for that top of book quote. To keep it very, very simple, I mean, if we were looking to trade an S&P 500 ETF, the top of book order quote might be a size of 10 shares, and that'll be the ask that you're getting quoted. On average, over the past year, we've traded 2,500 times that order book, top of order book size. So that's the ask that we're seeing on screen. Our regular type of quote is 2,500 times that. Now, what happens when you want a larger size than the top of book order, the top of book ticket, sorry? Well, then the market maker starts to charge you more. So as you gradually go out, you get pushed out in terms of your spread and how much you're paying. Because clearly, if you're coming in with a £100 order versus you're coming in with a £100 million order, you're going to get charged two different figures, because the market maker has then got a lot more market risk. They've got to work out, there's a number of varieties, but the factors that can go into it. But just to keep it simple, the greater the order size, you're going to have to go out and find a sort of market participant who's willing to take the other side of that trade.
Sure.
So that's a bit about the sort of market depth, and to give you an idea of not just only the screen bid and ask and mid, but also what's happening underneath the market and the depth of the market in terms of actual order size. So I hope that helps a little bit in terms of explaining that.
It's fascinating, and it's something that the vast majority, I mean, certainly something that I'm not as au fait with, the vast majority of advisors won't be aware of. So just to lift the lid a little bit and shine a light on the underlying fundamentals over and above just pushing a button to buy or sell. It's a little bit more than that, which you're illustrating quite nicely. Just moving on to the kind of discussion that you've had about spreads widening and volatility this year. Can you shine a light on that at all?
Well, yeah, exactly. As I was kind of speaking about at the beginning, I've got an example here, which is just it's our equity benchmark, which is the MSCI World in dollars, and this is just the iShares version. So this is an example of quite a high quality ETF, I would say, in terms of there's a large volume going through on the secondary market in terms of everyone's willing to buy and sell this kind of ETF. So there's a lot of liquidity in the secondary market, and that's reflected basically by a tight average spread. As I was kind of saying, this ETF usually trades with a 250-day moving average. It usually trades with about 5 basis point spread. So that's the difference between the bid and the ask. So where you can buy it and where you can sell it at. Back in March, as I say, that kind of blew out. You can see on the bottom of that subchart, it's the blue line. That's the spread, and it blew out to around 50 to 60 basis points when we were kind of going through that COVID turmoil in the markets, and no one knew what was going on. And to be honest, it was hot potato. I mean, no one wanted to be sort of run out of time and be holding this stuff. So everyone started charging more money to be trading these things, and that's kind of shown as well in the middle subcharts of just the volume that was going through at those times in terms of what was happening in the markets. So that's a little bit of an idea around how COVID impacted our trading and actually the magnitude of the volatility that we actually saw in markets in the past year.
Sure, and I think it's really important from our perspective. We need to look at this, and you said it right at the beginning. The reasons for trading: you'll trade if a client invests or wants to withdraw money, but you'll trade because you want to make a change to the underlying instruments within the Acumen portfolios. We could just sit on the assets that we had at that time. We didn't need to change the portfolios around, but we could have been left high and dry depending on what happened to the market. So we needed to react. We're active managers. We needed to act accordingly. But it's really important also to balance that against the need to deliver liquidity to the end client, because we're managing money for retail clients, and we can't be left in a position where clients can't get their money back. So it's a very fine balancing act, particularly when the cost of delivering that trade potentially could be widening by the day. So it's not a job that I envy, but it's something that you really have to. It's great for advisors to be able to see this and to appreciate the complexities involved, certainly during what has been an exceptional time in all of our lifetime, February, March of last year.
Exactly, and I mean we have discretion over the portfolio, so we have to run them how we see best fit. And at the time, we decided to move from those more liquid assets, which were charging the highest spreads. We wanted to move them more to the liquid assets in terms of, to keep it simple, in the fixed income world, kind of moving up the credit quality curve, and sort of go to more those liquid assets that we know, if worse comes to worse, we're not going to get charged through the roof to get out of if we need to, if we get redemptions coming through and we've got to pay out that cash. So that's sort of one of the challenges that comes with fund management, especially in turbulent times.
So in terms of so moving on from that, you make those decisions. We execute those trades for all those reasons, all the right reasons that we've just talked about. What does that impact in terms of cost to the client? What things do we need to look at? What extra cost does that bring potentially to the portfolio?
Well, the way that we measure trading costs is via slippage in the portfolios. Now, slippage over the past year has kind of crept up a bit because volatility has increased, and also the size of trades that we've been doing to kind of turn around our portfolios very quickly has also increased a bit. Now, what is slippage and how is it measured? Slippage is basically measured as the distance from mid to where we actually execute at, which I think is a little bit unfair, because you're quoting from a level which we would ideally like to be trading at, but isn't actually really that possible.
You said earlier on in the discussion that we can't execute at mid, so
well, exactly.
You're immediately losing, aren't you, from the calculation?
So you're automatically losing out on the spread. Add into that the fact that we're now running a vast amount of money, and we've got to do trade sizes which in the ETF market are actually pretty sizable. So we've kind of got a double act of having to pay the spread and also having to pay the sort of larger volume size as we have to request those from the market makers. So that's kind of how slippage is measured. As I say, it's you can get caught up on it because I can see that slippage numbers have kind of crept up a little bit. But when you take into account that actually volatility has been pretty sizable this year, to say the least, and also the changes that we've made in the portfolios, I think it's pretty justified of where it's at, and also given that it's measured from mid, which actually we would love to be trading in mid in a world where we could have direct access to markets and there was vast amounts of liquidity in the world. We would love to be trading at mid, but simply as a matter of the markets and how things actually work, unfortunately, that isn't the case.
I think it's I mean, that's really interesting. Thank you. And I think it's certainly important for me to point out that this isn't just exclusive to Tavistock Wealth. This is that the increase in trading costs and slippage costs is industry wide. Everybody's felt it because of the increase in volatility and the amount of changes that undeniably other portfolio managers have been encountering. I think certainly from my perspective, it's also really important to point out that all of our transaction costs, our slippage costs, are fully disclosed. We disclose them on our fact sheets. We declare our full hand so that the advisor and the investor knows what the all-in cost is. And unfortunately, despite MiFID II, that isn't always the case. And a lot of people aren't declaring slippage. It's a term that a lot of people won't ever have heard of. And so it's something that is potentially not comparing an apple with an apple. But I think we're doing the right thing by disclosing that full hand and being transparent. I think it's also really important to point out that the end performance number, sorry, Alex, is net of all of those costs. So we're carrying out these changes for the benefit of the performance of the portfolio and also the liquidity to the end client. And that's been seen in the numbers that we've been delivering over the last 9 to 12 months. First quartile performance, net of these increased costs. So again, you can't have your cake and eat it. There is no free lunch, as you quite rightly pointed out earlier on.
Exactly, and also to give us a high benchmark to be striving towards. It certainly keeps me on my toes to try and be achieving mid in the portfolios for execution. But it's something that we can strive towards, and it's as you say, it's us being transparent with the end client and showing how we've actually been trading. And actually that's kind of shown in our numbers really when we look at it. So our average saving versus the ask, so versus the screen ask, which is with that small size, that is typically been 0.004%, which might sound like a small amount, but we're still getting within the sort of respective bid or ask on our trades, which actually, given our size of trades, which are way outside of, as I say, they're over 2,500 times that of on the bid or ask. I think is kind of reflected in our in how well we're doing our trading. And then when you also look at the competitive nature, so going back to the beginning of how we trade, we put into competition 5 or 6 of those sort of market participants, and we put them into the room and we say, right, give us your best price for this trade. And our saving from the first quote that we actually go with to the second quote has roughly been around 7.4 basis points over the past year. So that just kind of shows the benefits of sort of going out there and going into the marketplace, as opposed to sending it off to one market dealer who will then execute for us.
Sure.
And putting these guys in a room and getting them to compete with each other. So I think that's kind of been reflected in our trading numbers.
That's really enlightening. I mean, there's loads that we can talk about here, loads more depth we can go into, but I think it's really important to know that we've got the control in-house, especially during really volatile times, to be able to maneuver the portfolios at the most cost-effective way. And actually the performance of trading, pitting those market participants against each other, has delivered returns to the end client, ultimately in cost saving, which is fantastic. There are two sides to, well, many sides to your job, I know, but two main functions that you fulfill. Trading, which I think we've shone a light on because it's really relevant and really topical, but also currency hedging and FX. They go in hand, of course they do. Currency spans the whole of the portfolio, all of the disciplines, all of the asset classes. I don't know whether you just want to comment a little bit on currency movements this year, what the outlook is for the next few weeks and months, and where are we positioned?
For sure. So this year, it's been a bit of a story of dollar strength, actually. We've seen basically the Fed come out with monumental fiscal and monetary supply, effectively. So they've just flooded the market with dollars. There's even been examples of helicopter money with the stimulus checks, with money literally going into the real economy. So, and with that, the Fed have expanded their outlook in terms of growth and unemployment to come down. And with that, basically, everyone's kind of flooded back into dollars, and that's pushed the dollar index and broader dollars up in demand. We see actually going a bit further down the line that this excess supply of dollars is going to start to weigh on the dollars as a broad index. And actually, when we look at, I was speaking the other day around the twin deficit, which is actually over 20% now in America, which is effectively the current account and the fiscal balance added together, which as I say now is over 20% in deficit, which will, as I say, further down the line, that will start to weigh on dollars. What does that mean for us as a sterling investor? Clearly, we've got all of our investments in sterling as they come into us, and then obviously we invest them out again, taking currency risk with our globally diversified portfolios. We then choose to hedge the majority of that exposure, not all of it, but we do hedge most of it. Roughly, we hedge all of our fixed income, and then we hedge roughly around 75% of our equities. And actually, sterling has been able to have a bit of a run up this year, being ahead in terms of vaccination rates, and also with the BOE coming out and sort of ruling out negative interest rates, means that sterling's actually been able to catch a bit of a bid, which has been nice. Sterling typically is characterized as a bit more of a risk-on currency. So as people go back to work and spend again in the real economy, and there's this sort of positivity in global markets, sterling will appreciate on those sort of aspects. And that's kind of what we've seen. We've seen a run up to, I think, the highs of sort of 142, and we're currently sitting at around 140. We're still watching technicals very closely to see if we're going to get a break of this 140 level that's kind of been bouncing around. But for now, we hold our position in being long sterling via our currency hedged sort of techniques in the portfolios. And we sort of in that we also remain short dollars as we see the supply, basically the oversupply of dollars, look to weigh on the dollar in the future.
That's really interesting. Thank you. I think also what the way in which you've just spoken illustrates a little bit of the more dynamic, the more tactical nature of our currency hedging. Certainly following the strategic review that we carried out at the beginning of last year, or middle of last year rather, I think we're much more mindful of the fact that we can potentially look to alter our positioning, correct me if I'm wrong, if we see a clear trend developing. You've identified there's a potential trend here for dollar weakness and sterling strength. Great, plays into the fact that we're hedging the vast majority of the portfolio back to sterling. But if that changes, then we have the ability and we have the dynamism to be able to switch that and to be able to react accordingly instead of just tracking it all the way down. Which is clearly your area of expertise.
Yeah, exactly. So we're kind of watching for currency markets look towards sort of longer term trends. And if you look at the longer term sort of charts, they tend to revert to areas around like purchasing power parity, PPP, and sort of longer range averages. So for sterling, that's around the 140 to 145 area. And that's what a lot of analysts are also picking up on. But at the moment, we also see street positioning allowing sterling to kind of rally up to those areas. And yeah, as you say, that's when we'll sort of look to reassess how we carry out our currency hedging solution, and sort of look to see if we need to take some of that hedge off the table, or if we've still got a bullish outlook for the currency.
Plenty of opportunity, plenty of things to keep you occupied and on your toes, I know. Alex, that's been, from my perspective, really, really interesting. I think all the viewers will think the same. It's really good to also bring some life to the trading through the slides. So thank you for putting those together. And thank you for your time. We'll expand on this on the next session with you as well. I'm sure there'll be loads to talk about. But in the meantime, enjoy the freeing of lockdown, getting back into the world, and I look forward to seeing you in person in the not too distant future.
Sounds great. Cheers,
Alex,
Steve.
thanks for your time. Do appreciate it. Cheers.